Hi, and welcome to Knowledge Shop's first tax roundup for 2026. In this update, we're getting straight into the key rulings and decisions you need to know about as we start the new year. First, with Mike, we'll look into the ATO's new focus on pathway rate and personal services income, discussing who it impacts and the practical steps for advisors. Then with that, we'll break down two significant recent cases, the ART's decision in Applebee on working from home expenses and the full federal court's ruling in Kilgour on market value for CGT. And finally, Jason will take us through the proposed tax on super fund earnings for members with balances of over $3 million. Now let's get started. The ATO has finalised a practical compliance guideline on the potential application of pathway rate to situations involving companies and trusts that derive personal services income and pass a PSI test. Michael, can you provide an update on which clients would be impacted by this document and the key issue that the ATO is focusing on?
Yeah, the ATO has released a final version of its practical compliance guideline looking at the possible application of the general anti-avoidance rules in Part 4A to scenarios where a company or a trust is generating personal services income but is able to pass the PSI test. So when we're thinking about this guideline and who it might be relevant to, well, really it is those clients who are operating a business through a company or a trust. That business involves the derivation of personal services income, which is basically income that is mainly a reward for the personal efforts or skills of a particular individual. And where we're confident that that entity is able to pass the PSI test. Now, that last part's pretty crucial because if the entity couldn't pass the PSI tests, then Part 4A isn't really a problem. And the reason for that is that the PSI rules would basically do the ATO's job for it. So when the PSI tests are failed, we have automatic attribution of net PSI income, but also losses to the individual who performed the work. It's not necessary for the ATO to kind of try and use Part 4A to do that. However, where the PSI tests are satisfied, look, we've seen over the years a pretty widely held belief, misunderstanding, that once you pass the PSI test, really, you've got a whole lot of flexibility in terms of what you do with those profits. You could retain them or distribute them out to family members on lower tax rates. Well, look, the ATO has never had that view, and the ATO has made it pretty clear, so have the courts, that that isn't really a position that is supported by tax cases, but also the ATO's guidance. Now, the ATO has had guidance in this area for a number of years. The ATO has done a fair bit of work over probably the last maybe year or two to refresh and update and flesh out that guidance. And this final PCG, so PCG 2025/5, is the latest in a line of ATO guidance in this area. This just happens to be a fair bit more detailed than what we've seen in the past. So basically what the ATO is saying is that, look, if you are using a company or trust to derive PSI and you pass the PSI tests, that's nice. You don't have to apply the PSI attribution rules. You can potentially claim a greater range of deductions for your business activity. However, that doesn't give you free rein in terms of what you do with those profits. The ATO says that the general anti-avoidance rules in Part 4A could potentially apply if you generate PSI in a company or trust, you pass the PSI tests, and those profits are either split with other parties, particularly if they're on a lower tax rate, or those profits are retained in the entity, which would be more relevant when we're dealing with a company situation. The ATO says that if you want to minimize the risk of Part 4A applying, really the full amount of that PSI profit should be paid out to the person who performed the work, should be taxed in their hands in the same year that it's derived by the company or the trust. And effectively what this PCG does is set out a number of lower risk scenarios and higher risk scenarios, just so that taxpayers and their advisors get a good understanding of where the risk lies. What are the types of things that the ATO is more likely to target? What are the types of arrangements that the ATO is probably not going to worry too much about? Look, the ATO has limited resources. They're not going to go after everyone. And so this is really the ATO saying, look, these are the scenarios that we're more likely to devote our resources to. So we have a whole bunch of examples in the PCG. Some of them are basically copies of what was in the draft version of the PCG that was released a little bit earlier. But we do have some new scenarios that are being covered and some kind of modified scenarios as well, which is quite helpful. Now, a couple of things just to keep in mind as we're thinking about this PCG, what it means in practice. The first one is materiality. Now, the ATO says that if you find yourself or your client is in a higher risk scenario, well, there is a risk, a heightened risk that Part 4A could apply to that, regardless of the numbers involved. However, again, remember, the ATO has limited resources. The ATO acknowledges that it is more likely to devote those resources in situations where the numbers are bigger. It makes sense. The ATO is going to spend more time collecting, potentially, the larger tax liabilities that might be owed. So that's the first thing. Materiality, there's a practical element here. The bigger the number, the higher the risk. The second thing which we see in the final version of the PCG is, I wouldn't necessarily call it kind of an amnesty period as such, but the ATO does say that, look, taxpayers who might find themselves in a risk position when it comes to Part 4A shouldn't necessarily expect the ATO to come looking for them, as long as they are taking genuine attempts to move to a lower risk position by 30 June 2027. So despite the fact that the ATO has released guidance in this area over many years, the ATO does acknowledge that, look, yes, there's a possibility that there's a whole bunch of people out there who just weren't aware of the ATO's views in this area. They didn't realise that what they were doing was potentially exposing them to Part 4A risk. The ATO seems to be saying, look, now's the time to acknowledge that, and now's the time to start taking steps to move towards a lower risk position. 30 June 2027 is your deadline for doing that, so that you still have that slightly lower risk of the ATO coming and looking at your affairs in detail. So doesn't necessarily guarantee you won't have a Part 4A problem, but certainly if we're identifying scenarios that are higher risk than maybe what they should be, the ATO is suggesting that there's a period of time where the ATO might be a little bit more lenient, I guess, in terms of how Part 4A is applied.
Thanks, Mike. What are some of the practical things we should be keeping in mind when advising clients in this area?
Now that we understand, roughly, broadly speaking, what the ATO's concerns are and what this guideline is really aimed at, let's have a think about a few practical scenarios that are presented and discussed in the PCG. The first one is around retention of profits. Now, I said earlier that what the ATO is really looking for is scenarios where PSI profits are retained in a company or are split with others on lower tax rates. So when it comes to that retention of profit issue, it is something that potentially causes some practical issues. What if you're running a business, you're generating PSI, making some profits, but there is a real commercial need for funding within that business? And I guess over the years, people have kind of grappled with that. Well, do I really have to pay out all the profits this year, have them taxed in the hands of the person who did the work, only for that person to have to kind of tip those funds back into the company, maybe as a loan or extra share capital, just to fund kind of ongoing business activities, maybe the acquisition of new assets, etc. Well, what the ATO is suggesting in the PCG is that there is some flexibility here. It's to some extent a bit of a common sense approach, but you do need probably a bit of documentation and evidence to support the retention of profits. You need to show that there's a clear commercial purpose for that and that the retention really is temporary. So, for example, if the business needs to invest in a new asset, basically to continue to operate or to grow, the ATO suggests that it's okay to retain profits if the purchase of that asset is basically imminent. You have genuine plans to purchase that asset. You know roughly how much it's going to cost. Yeah, it would be okay to retain some profits in order to make that business purchase. However, if that purchase never goes ahead and you just keep the profit sitting there in the company, or it never seems like you really ever intended genuinely to acquire that asset, well, the ATO says that is probably on the higher risk sort of side of things. The second scenario, which hasn't really been addressed in the past and is addressed in the PCG, which is great, is a scenario where we're dealing with silent investors. So you might have someone who's running a business through a company or a trust. They are doing all of the day-to-day work, but someone has assisted them with some funding, some capital, maybe to get that business up and running in the first place. Now, the question that kind of has been raised over the years is, well, as that business generates profits, do we really have to give all of those profits to the person doing the work so that they're taxed on everything? Do we have a problem, I guess, if we give some of those profits back to the silent investor? They're not involved in the day-to-day work. They're not performing, I guess, the day-to-day personal services, but they did genuinely provide some funding, some capital for that business. Again, pretty common sense, but the ATO is saying, look, it's okay to have a silent investor, and it's okay for some of the profits to be returned to them, basically, in accordance with the commercial agreement that has been reached by the parties. Now, again, you need to kind of have a look at the numbers. You need to look at that arrangement. You need to make sure that the person doing the day-to-day work is being remunerated appropriately for that. However, where someone else has made a genuine commercial investment in the business, it's okay for them to, from a tax point of view, receive a genuine commercial return on that investment. So that's good news, and it's nice to have some clarity from that from the ATO. The third thing is around partnerships. Now, you might remember I said a little bit earlier that this PCG is primarily focused on the situation where a company or trust is being used to generate personal services income. What about partnerships? Well, this is an interesting one, and partnerships have always been treated a little bit differently. Now, first of all, if a partnership is earning personal services income and it fails the PSI tests, then we will have attribution of the net PSI amount to the person who did the work. That might be just one of the partners who's doing the day-to-day PSI type work. If, however, the partnership is able to pass the PSI tests, do we have the same sort of Part 4A problem if the profits generated from that business are split between the partners in accordance with their partnership interests and the partnership agreement? Now, in the past, the ATO has typically said, no, that isn't a Part 4A issue. If we have a genuine partnership in place, the partnership makes a profit, and those partnership profits are split in accordance with the partnership agreement, the ATO has traditionally suggested that that won't automatically give rise to a Part 4A problem. My understanding of that, it's not really set out in the guidance, is that as partners in a partnership, you're jointly, severally liable for debts of the partnership. So even if you're not involved in the day-to-day running of the partnership, you are certainly exposed to some risk. And you may well have contributed, I guess, some capital to that partnership as well. The ATO in the final PCG does broadly, briefly discuss partnership situations. This was something that Knowledge Shop raised with the ATO in response to the draft PCG. The ATO had said, look, we don't intend for this guidance to cover partnerships, and that was the end of the story. We had asked the ATO to kind of flesh that out a little bit. This is a common problem area. It's helpful to have some extra guidance on this, particularly because the ATO had removed some of its guidance on partnership situations from its general website guidance. Well, I'm pleased to say that the ATO has included a couple of paragraphs in the PCG, the final version, dealing with partnerships. And thankfully, the guidance from the ATO is pretty consistent with what we've seen in the past and what we see in a couple of other places if you go looking for it. And that is, if you have a genuine partnership arrangement, you don't necessarily have a Part 4A problem if the partnership is able to pass the PSI tests and the profits are split in accordance with the partnership agreement. You don't necessarily have to, channel all of the profits to the partner who's doing the day-to-day work. It's okay for another partner who maybe isn't as involved in the day-to-day work to receive a share of those profits and be taxed on those. A common example of this would be genuine partnerships between spouses. You might have one partner doing most of the principal work, with another partner providing maybe some admin support, but they're also exposed to liabilities. They might have provided some capital upfront as well. Now, that's not to say that you could never have a Part 4A problem. The ATO says you could if the arrangement seems artificial or contrived. There might be situations where there are features that suggest that this is an arrangement that has been structured primarily for a tax purpose. It doesn't really have kind of solid commercial footing. So you still need to be a bit careful, but the ATO does say genuine commercial partnership, often between spouses, it's okay to split the profits between the partners if the PSI tests are satisfied. So that's a good thing, and it's nice that the ATO has picked up on the suggestion that we made to include a bit of extra guidance in that, because it is something that affects quite a range of taxpayers. So helpful guidance from the ATO. As I said earlier, it really expands on and kind of takes us further than what we've had in the past in this area. We've got the ATO providing us with, I think, some pretty helpful examples, actually dealing with some scenarios that weren't previously covered. There's an acceptance of, a level of materiality in terms of when would the ATO kind of bother kind of investigating these sorts of scenarios. But I think as a overall picture, We do have a nice bit of guidance here, which I think will be helpful as we help clients navigate these types of scenarios.
Thanks, Mike. And the ART recently handed out a decision in Applebee that looks at some of the common working from home expenses. What were some of the key takeaways from the Applebee decision?
Thanks, Amy. In the Applebee decision, the taxpayer, Mr. Applebee, was a senior technical solutions consultant who was required to work from home during COVID-19. But from around mid-June 2020, his employer began a staged return to the office. Although he was permitted to return, he continued working from home for around 3 days per week. The taxpayer here argued that the combination of COVID-19 restrictions, his on-call arrangements, and security requirements of his job meant that his home office had the character of a place of business even after the staged return to the office. So the tribunal here did not accept this argument. While the Home Office was clearly required during the initial lockdown period, the tribunal found that by mid-June 2020, the taxpayer's actual workplace had reverted back to the employer's company office. From that point on, the Home Office was treated as an adjunct or extension of the office, rather than a separate place of business in its own right. As a result, the ART held that his occupancy expenses were not deductible. The tribunal also placed little weight on a letter from the taxpayer's supervisor, stating that working arrangements called for a home office. The wording was considered to be too general and lacked clarity. There was no clear evidence that the taxpayer was positively required to maintain a home office, including for his on-call duties. And the fact that the home office had been approved by his employer was seen as no more than the employer meeting its workplace health and safety obligations rather than evidence of a business necessity. So turning to car expenses, the tribunal was not satisfied that the taxpayer's logbooks were accurate, complete, or contemporaneous. Multiple inconsistent versions were produced, and there was no clear explanation of how they were prepared. And notwithstanding this, once the Home Office was found not to be a place of business, then the travel between the home and the office was not deductible anyways. For mobile phone and internet expenses, the tribunal took a mixed approach. So while the taxpayer had claimed very high work-related percentages of over 90%, the tribunal was prepared to allow mobile phone deductions of 50%, which was more than the 30% allowed by the Commissioner. For internet expenses, the taxpayer failed to discharge the onus of proof for a higher internet usage claim of 91.8%, and the tribunal was not willing to go beyond the percent that was already allowed by the Commissioner. However, the taxpayer was successful in relation to subscriptions and software deductions. So deductions for Microsoft Office, Dropbox, and Adobe programs were allowed. The tribunal accepted that these subscriptions directly supported Mr. Applebee's work duties, were used in performing tasks for his employer, and that the corporate policies in place had restricted his personal use. Finally, on penalties, the ART upheld the administrative penalty of 50% that was applied for recklessness and declined to reduce it, as the taxpayer was unable to establish grounds for remission. The Applebee decision demonstrates that once COVID-19 restrictions eased, working from home will generally be treated as a matter of choice unless there's clear and specific evidence of an ongoing requirement. The decision also reinforces the importance of reliable contemporaneous records, in particular for car expenses.
Thanks, Anne. Now, the full federal court appeal in the Kilgour case looks at market value for CGT purposes for the maximum net asset value test. What were the main issues here?
Thanks, Amy. The Kilgour case concerned capital gains arising from the sale of shares in Punters Paradise, a business operating an online social platform for racing and sports betting tips. In October 2016, all of the shares were sold to News Corp Australia. At the time of the sale, the shares were held by 3 family trusts. 2 of those trusts each held 20% of the shares, and the taxpayers, Miss Kilgour and Miss Easterling, were presently entitled beneficiaries of those 2 trusts. As a result of the sale, Ms. Kilgour was assessed on the capital gain by reference to the trust distribution that she received. The capital gain was calculated using the market value of the shares. In the case, Ms. Kilgour argued that she should be assessed on a lower capital gain because she qualified for the small business CGT concessions. In particular, she contended that she satisfied the maximum net asset value test because the market value of her 20% shareholding was less than $6 million, even though the actual proceeds received exceeded that amount. Her arguments focused on several points. She argued that News Corp paid more than the true market value because it obtained benefits unrelated to the inherent value of the minority shareholdings themselves. She also argued that the sale was not conducted at arm's length and that under the market value substitution rule, the actual proceeds should be replaced with a lower market value. In addition, she contended that for CGT purposes, each 20% parcel should be valued in isolation, as if it were a standalone transaction, rather than as a part of a coordinated sale of all the shares. Finally, she argued that the commercial benefits News Corp obtained from acquiring full ownership and control of Punters Paradise were benefits to the purchaser and should not inflate the value attributed to the minority interests sold. So the full federal court in the case rejected all of those arguments. The court found that the parties to the share sale agreement were dealing with each other at arm's length, and as a result, the market value substitution rule should not apply. The court also confirmed that the capital proceeds actually received were an accurate reflection of the market value of the shares. And importantly, the court rejected the idea that the minority interests should be valued in isolation, or that synergistic benefits should be stripped out. Where shares are sold together as part of a coordinated transaction at arm's length, the market value can properly reflect the price paid for the transaction, including any value perceived by the purchaser in acquiring the full ownership. The practical outcome was that the beneficiaries of the Kilgour Trust did not satisfy the maximum net asset value test and therefore were not entitled to access the small business CGT concession. The key takeaway from the case is that where minority interests are sold as part of a coordinated arm's length sale of 100% of a company, the actual sale price will generally represent the market value for CGT purposes. Attempts to discount minority interests by excluding purchaser synergies or by valuing parcels in isolation are unlikely to succeed, particularly where access to the small business CGT concessions is at stake. However, just note that the taxpayers have now applied to the High Court for special leave to appeal the decision in January of this year.
Thanks, Sam. Now, Jason, I understand that there have been some developments with the proposed tax on super fund earnings for members with balances of over $3 million. Now, what are we currently at with this proposal?
Thank you, Amy. Division 296. So that is our proposed additional tax on earnings that apply to superannuation balances above $3 million. So it's certainly been a long road since this tax was first proposed, but we did have some major developments late in 2025. So initially, the government came out with an announcement and a fact sheet, and that announcement was that they were going to move away from looking at a increase in total super balance method and move more towards a traditional taxable income method to track the income for this proposed new tax. Also in that announcement, the government did indicate that they will apply indexation to the thresholds, and they also announced a second threshold. So what was originally proposed is that tax on earnings on amounts above $3 million will be taxed at an extra 15%, but the October announcement extended that further. So we would still have our extra 15% on those earnings on balances above $3 million, but when we get to $10 million, then there'll be an extra 10% tax applied to that. So an extra 25% in total on the $10 million. So effectively, in simple terms, looking at a tax rate of 30% for earnings on balances between $3 million and $10 million, and then a total of 40% on amounts above $10 million. So moving on from that announcement, just before Christmas. So you're either busy getting ready for your Christmas break, or perhaps you'd even gone on your break. Then the government released draft legislation to take those proposals a bit further. So the draft legislation has a start date of 1 July 2026. TSB will still be looked at. One key change is that previously it was proposed that we would only need to look at the TSB at the end of each financial year. So that provided some opportunities each year for perhaps members who wanted to opt out for that particular year to make withdrawals each year. That has changed in the proposal. So what will now happen is that we'll look at the total super balance at the start of the financial year and the end of the financial year, and then we will use the higher one. So there may not be as many opportunities going forward to opt out of Division 296 tax if someone is over the 3 mil at the start of the year. But it is proposed that there'll be a 1-year transitional period. So in that first year, so that will be the financial year 2027. In that first year, the government will look at the end of financial year TSB. So in that case, if someone did really want to opt out of this tax, they could withdraw below the 3 million before 30 June 2027, and then make sure that they stay below that figure going forward. So as with the October announcement, the draft legislation includes that we'll be looking at tax principles. So looking at traditional tax principles at the super fund level, but carving out things like taxable contributions, NALI, and effectively ignoring the ECPI. And then also there may be a little bit more work for accountants and administrators going forward. So the ATO will identify some in-scope funds, and where a fund is in scope or where a fund has a member that's in scope, then there will be some extra calculations required to apportion that income, portion the fund income to that member for Division 296 purposes. So that may also require a different type of actuarial certificate that we're used to, but we're still waiting on further final legislation and also some regulations to do that. It is also proposed that there will be this ability to set a cost base of all CGT assets on 1 July 2026. So that's not resetting the cost base for general CGT purposes, but it would be setting a new cost base for Division 296 purposes. So that means if a fund has held an asset for many years and that has some embedded capital gains, then they won't be penalised in the Division 296 system for those prior gains. That does require an election to be made in advance, and that's irrevocable. So at this point, that election would reset the cost base for Division 296 on all CGT assets. So whether those assets be in gain position or loss position, it would set those cost bases going forward for all assets. So no ability at this point in time to choose particular assets. It would apply to all. So the election can be made. So we may have some funds where members perhaps aren't at the 3 million at this point. Perhaps they're at 2 mil, or they feel that they will be at the 3 million. They can still make that election, and then that may provide them with some benefits down the track if their balance does grow and they make some large capital gains. So a little bit of extra work for accountants, and certainly watch this space for developments. I know there's some industry feedback has gone in during the consultation process, and there's some discussions to be had, but we will need to start to talk to our relevant clients around perhaps whether they make those elections or not. And then we'll need to look at the final legislation just to see what might be needed to be able to make those calculations to apply the earnings to affected members. So a lot to take in, and we'll keep you up to date as further things transpire. And we hope to see the final draft in the coming weeks or months, certainly well before 1 July 2026.
And that wraps up our first tax roundup for 2026. A big thank you to Michael, Anne, and Jason for clarifying those essential updates on Part 4A, compliance for personal services income, the practical implications of the Applebee case for working from home expenses, and the key takeaways from Kilgour case on the market value for CGT purposes, as well as the Division 296 tax updates. Now, to support your clients with confidence and Knowledge Shop membership is a complete solution for accountants and advisors. You get direct access to our expert help desk for your complex client queries, tax technical updates, a vast library of technical resources and work papers, as well as a comprehensive suite of CPD training to fulfill your requirements. We would love to hear from you. Just contact us to book a quick personalized demo and see how we can help you and your clients make a difference. Now, thank you very much for watching, and we'll see you next time.